Hi, today I want to speak about income statement. The income statement is an important part of a company's performance reports. The income statement focuses on four key items: revenue, expenses, gains, and losses. It does not differentiate between cash and non-cash receipts, sales in cash versus sales on credit, or the cash versus non-cash payments, disbursements, purchases in cash versus purchases on credit. It gives an account of how the net revenue realized by the company gets transformed into net earnings, profit or loss. For a company manufacturing a product or retailer involved in the business of selling that product, the revenue from primary activities refers to revenue achieved from the sale of the product. Similarly, for a company in the business of offering services, revenue from primary activities refers to the revenue of or fees earned in exchange of offering those services. Non-operation revenue, often referred to as non-operating recurring revenues. These revenues are sourced from the earnings which are outside of the purchase and sale of goods and services and may include income from interest earned on business capital lying in the bank, rental income from business property, income from strategic partnerships like royalty payment receipts, or income from an advertisement display placed business property. Gains. Also called other income, gains indicate the net money made from other activities like the sale of long-term assets. This includes the net income realized from one-time non-business activities, like a company selling its old transportation van, unused land, or a subsidiary company. Primary activities expenses. They include the cost of goods sold, COGS, selling, general and administrative expenses, CG&A, depreciation or amortization, and research and development (R&D) expenses. Secondary activity expenses. There are all expenses linked to non-core business activities like interest paid on loan money. Losses. While primary revenue and expenses offer insights into how well the company's core business is performing, the secondary revenue and expenses account for the company's involvement and its expertise in managing non-core activities. Compared to the income from the sale of manufactured goods, a substantially higher interest income from money lying in the bank indicates that the business may not be utilizing the available cash to its full potential by expanding the production capacity, or is facing challenges and increasing its market share amid competition. Income statement structure. To understand the above details with some real numbers, let's assume that a fiction sports merchandise business, which additionally provides training, is reporting its income statement for the most recent quarter. It received 25,000 from the sale of sports goods and 5,000 from training services. It spent various amounts as listed for the given activities that total 10,000. It realized net gains of 2,000 from the sale of an old van and incurred losses worth 800 for settling a dispute raised by a consumer. The net income comes to 21,000 from the given quarter. The above example is the simplest forms of the income statement that any standard business can generate. It's called the single-step income statement, and it is based on simple calculation that sums up revenue and gains and subtracts expenses and losses. Real-world companies often operate on a global scale, have diversified business segments offering a mix of products and services, and frequently get involved in mergers, acquisitions, and strategic partnerships. Listed companies follow a multiple-step income statement. Different measures of profitability in a multiple-step income statement are reported at four different levels in a business operations: gross, operating, pre-tax, and after-tax. Let's look at the most recent annual income statement of two large publicity-listed multinational companies from different sectors of technology, that's Microsoft, and retail, it's Walmart. The first section, titled Revenue, indicates that Microsoft's gross annual profit for the fiscal year was 72 billions. It was arrived at by deducting the cost of revenue, 38 billion, from the total revenue, 110 billion, realized by the technology giant during its fiscal year. Around 35% of Microsoft's total scale went toward costs for revenue generation, while a similar figure for Walmart was around 75%. It indicates that Walmart incurred much higher costs compared to Microsoft to generate equivalent sales. The next section, called Operation Expenses, again takes into account the cost of revenue, 38 billion, and total revenue, 110 billion, to arrive at the reported figures. As Microsoft spent 14 billion on R&D and 22 billion on selling, general and administrative expense, CG&A. The total operating expenses is computed by summing all these figures, 38, 14, and 22. So in total it will be 75 billion. Reducing the total operation expenses from total revenue leads to operating income or loss as 35 billions. This figure represents the earnings before interest and taxes, EBIT, for its core business activities and is again used later to derive the net income. A comparison of the line items indicates that Walmart did not spend anything on R&D and has higher CG&A and total operating expenses compared to Microsoft. The next section, titled Income from Continuing Operations, adds net other income or expenses like one-time earnings, interest linked expenses, and applicable taxes to arrive at the net income from continuing operations, 16 billion for Microsoft, which is 60% higher than that of Walmart, 10 billion. After discounting for any non-recurring events, the value of net income applicable to common shares is arrived at. Microsoft had a 68% higher net income of 16 billion compared to Walmart's 9 billion. The earnings per share are computed by dividing the net income figure by the number of weighted average shares outstanding. With 7 billion outstanding shares of Microsoft, its EPS comes to $2.15 per share. With Walmart having 2 billion outstanding shares, its EPS comes to $3.29 per share. So, though the retail giant beats the technology leader in terms of annual EPS, Microsoft had a lower cost for generating equivalent revenue, higher net income from continuing operations, and higher net income applicable to common shares compared to Walmart. Uses of income statements. Though the main purpose of an income statement is to convey details of profitability and business activities of the company to the stakeholders, it also provides detailed insights into the company's internal for comparison across different business and sectors. Such statements are also prepared more frequently at the department and segment levels to gain deeper insights by the company management for checking the progress of various operations through the year, though such interim reports may remain internal to the company. Creators may find limited use of income statements as they are more concerned about a company's future cash flows instead of its past profitability. Research analysts use the income statement to compare year-on-year and quarter-on-quarter performance. One can infer whether a company efforts in reducing the cost of sales helped it improve price over time, or whether the management managed to keep a tab on operating expenses without compromising on profitability. An income statement provides valuable insights into various aspects of a business. It includes a company's operations, the efficiency of its management, the possible leaky areas that may be eroding profits, and whether the company is performing in line with industry peers. So that's all.